All right, I know what your feed looks like right now. Iran, Gulf, Strait of Hormuz, oil, gas, world on fire thumbnails, every channel acting like they personally discovered a map. So let's slow it down and do this the Tyler way. Calm brain, sharp eyes. Why does Iran, not a huge economy and heavily sanctioned, still move global markets like it's a giant? And more importantly, what are the realistic scenarios and how can a trader read this without getting hypnotized by headlines? Quick intro. I'm Tyler White. This channel is economics, finance, and trading in plain English. Subscribe, please, because I'm about to drop a whirlpool of info. And if you hit like right now, I'll give you +5 luck for 48 hours. That's not a promise, that's a vibe. Appreciate you. Also, quick note, my DMs today are basically two types of message. 1, Ty, should I panic? And 2, Ty, what do I buy right now? And I'm gonna save you some stress. This video is not panic. It's not buy buttons. It's understand what moves the board so you don't get played by the loudest headline. Now, first truth. Iran itself doesn't directly run world stock indices. Their domestic economy is relatively closed. A lot of internal demand plus trade with allies and workaround channels. So if you're expecting Iran's GDP to be the thing that moves the S&P, that's not the story. The story is geography. Iran sits next to 2 choke points that act like the world's shipping throat. And when your supply chain gets a hand on its throat, markets don't wait and see. Markets panic first and then ask questions later. Let's start with the one everyone keeps yelling about, the Strait of Hormuz. It's a narrow passage between Iran and on one side, the Arabian Peninsula, and UAE on the other side. The point isn't just that it's narrow. The point is, it's controllable. Even simple military pressure can create fear there, because commercial shipping doesn't like bullets. Shocking, I know. Roughly about 1/5 of global oil shipments move through Hormuz. The Gulf has major producers. Saudi Arabia, UAE, Kuwait, Qatar, Bahrain, and others. And a lot of that oil exits to the open ocean through this corridor. So every time the Middle East heats up, you hear the same sentence: Iran might close Hormuz. Historically, Iran has threatened it more than it actually has done. Because if you actually choke off that artery, you don't just annoy one country. You trigger basically every Gulf state survival instincts. They're not going to watch their export lifeline get strangled by just a shrug. But here's why markets react hard anyway. Markets trade risk, not certainty. Even if the probability is not high, the damage would be so high that the price moves before the final answer shows up. And in the current escalation people are talking about, you've probably seen reports like this. Iran intends to restrict traffic. Shipping slows, vessels pause, insurance premiums jump. Some ships reroute or wait. Whether every single headline is perfectly accurate in real time is not even the point. The point is, if traders believe the flow might get disrupted, energy prices react instantly. And that's not just oil. A lot of LNG flows and gas-related shippings from the region matters too. Qatar in particular is a big deal for gas flows to the global market. So when you see Europe react sharply, it's often because Europe is sensitive to gas pricing shocks. If the market starts pricing in gas supply risk, European equities can wobble faster than US indices because energy costs filter into industry and inflation expectations. And you get that classic domino chain. Energy spikes, production costs spike, inflation risk rises, rate expectations shift, and stock indices get nervous. And that's the mechanic. That's the chain. And look, this is where traders either get sharper or they get worse. Doom brain goes, everything is crashing, I'm doomed. The trader brain goes, okay, energy up means cost up. Costs up means inflation pressure. Inflation pressure means policy expectation change. You're not predicting the future. You're watching which lever is being pulled. Another thing people miss, Sometimes crude moves, but product moves harder. Diesel, jet fuel, shipping-related products, these can react aggressively when logistics get stressed because the market is pricing real-world bottlenecks. So you can absolutely see a world where crude stabilizes in one zone while refined products whip around like they drank 3 energy drinks and got bad news. And why does that matter? Because expensive fuel is basically a tax on everything. Manufacturing, shipping, food distribution, retail, airlines, pretty much your whole modern life. So yes, energy isn't just one sector, it's a multiplier. Now, Hormuz is the loud one, but it's not the only one that actually matters. Iran has long influenced the region through proxy groups, and one of the big fears in any escalation is pressure around the Bab al-Mandeb Strait, the southern entrance toward the Red Sea and the route that leads to the Suez Canal. Here's a mental picture. If Hormuz is a throat, Bab al-Mandeb is like the other side of the airway, the route that connects massive trade flow between Europe and Asia. And people remember what happened when a single container ship blocked the Suez Canal. One accident created global chaos. Now imagine the fear if shipping companies think there is an active threat, even if the threat is possible, not constant. Again, markets trade risk. So if both choke points get pressured, even just in perception, the stress hits Europe and Asia harder. Now let's talk scenarios like adults, not like doomsday TikTok. Now, the first big question, can Iran actually control these choke points long term? These are narrow, yes, but the region isn't empty. There are navies. There are Gulf monarchies with massive incentives to keep the export routes open. There's US presence in the region historically. There are logistics, diplomacy, and also escalation management. So long-term control, it's not guaranteed. But as a trader, you don't need guaranteed. You need probabilities and timeframes. So let's outline 2 broad paths. Scenario A, fast stabilization, market greed. If the conflict de-escalates quickly, shipping normalizes, and energy prices cool off, markets often respond with relief. And in that case, you can see oil stabilizing or pulling back up, risk assets recovering, volatility dropping, and this is pressure valve open scenario. Now, scenario B, dragging conflict. Markets stay tense. If the conflict stretches and disruptions remain even semi-active, then every week adds stress. Energy remains elevated or jumpy, inflation risks stay on the table, indices can get choppy, certain sectors get squeezed, transport, manufacturing, while others can benefit, like energy producers. This becomes a slow grind scenario. The market doesn't need a single apocalypse moment. It can bleed via uncertainty. You'll hear wild oil targets, and that's normal. Fear sells. Could prices rise? Sure, they can. If disruption is meaningful and sustained, prices can climb. But those extreme numbers tend to require extreme sustained breakdowns. And the world doesn't just sit there doing nothing if energy supply is threatened. You have strategic reserves, production adjustments, rerouting, policy pressures, and all that messy things that exist in reality. So instead of worshiping the number, think like a trader. What's the next zone? What's the next reaction? What's the risk if the headline flips tomorrow? Here's the practical part. If you want to trade geopolitics, you need 2 skills. Separate signal from noise, react with a plan, not emotion. And this is exactly why I push my Telegram so hard. It's not because I'm obsessed with sending you guys links, but because YouTube is slow. Headlines are fast. Markets are even faster. And in my Telegram, I drop short voice updates when things start to move around. I'll tell you what matters, what I'm watching, and what's likely just noise. And if you've heard me repeat this, stay calm, stay structured, that thing before, yeah, that's on purpose. Because the market changes outfits every day. But human psychology is the same old roommate. The same fear, the same FOMO, the same tell me what to do right now. So I'd rather repeat the part that keeps you alive than invent a new catchphrase for clout. Also, guys, a quick reminder, I go live once a week, real session, teaching, trading, the whole vibe. And honestly, the weekly live isn't just about charts. It's serotonin, dopamine, and new connections, new brain wiring. Yes, I said brain wiring. Trading done right literally rewires how you think about risk. So if you want to stay flexible and learn to navigate both up and down markets, that's where the community helps. You're not alone in the fog. All right, that's the quick breakdown. If this video helped, subscribe to the channel. Like if you want more macro to trading explanations like this, and check the Telegram, link in the bio and in the first comment. I'll keep you guys updated as the story evolves.